Hello. Welcome to this episode of To the Point. I'm Neil Stanley. Today we're going to talk about this pricing environment and what it means for your deposit pricing activity. The interest rate environment has certainly increased and spiked in 2023 with FHLB advance rates in the mid fives and the Fed funds rate at 5.25 as we prepare this material for you. The economic environment is unlikely to allow interest rates to decline anytime soon because of the stickiness of PCE with the exclusion of food and energy. It's hanging right in there above 4%. We do know that CPI has recently dropped to 3%, and that's advantageous for the Fed to stop raising rates. But at this point, we're at 5.25, and it looks like we're going to be at that level for a while. What does that mean for our deposit competition? We know that when it comes to deposit competition in marketplaces across the country, there is a wide dispersion of offering rates. Let's take the 12-month, for example. We have rates anywhere from 0.01 up to the mid fives. What that means is that we're seeing lots of bank differentiation. Some banks are saying, hey, we're just going to keep our rates low. Some are out there competing to try to win business. And so there's a wide disparity of strategies playing out. And what we need to do is understand how to create a durable competitive advantage in this marketplace. So when we look at the data for the first quarter from the FDIC data, we find that oversized margins, having really low cost of funds, is not compensating for undersized volumes. So we're looking at the data. We can see that those financial institutions that comprise the lowest cost of long-term savings, the 10% that had the lowest cost had an average CD portfolio yield of 0.62. We love the fact that they created a nice big spread to Fed funds in that first quarter, almost 400 basis points. The problem is they're only keeping less than 1% of the market. So when you add up their profit, it's about 2% of the market's profit. Meanwhile, on the other end of the spectrum, those paying the highest interest rates average 3.58. Now that sounds like a really high cost of funds because of where we've been for the last 15 years. But when we look at what the average Fed fund rate was, we see that they're created almost 100 basis points of profit. And when you put together the volume and the spread, you find that they captured about 35% of the industry's profit in those top paying 10% of banks. So we should never forget that profit is not merely spread. It's a combination of volume and spread. A saying that I heard a lot in my younger days is pigs get fed, hogs get slaughtered. When you try to take it too far, people turn the other way. You're going to lose traction. So this quote is a very important one for those people striving excessively to hold down cost of funds. Just because depositors may be slow to move doesn't mean that they won't eventually respond. We need to find a way to capture volume while maintaining an appropriate spread. So when we look at these marketplaces, we know this. Across the country, we find that there's going to be the bottom third, the middle third, and the upper third that's still profitable. Yes, we want to avoid this top part that is unprofitable when it comes to treasuries or other riskless investments. But when we look at the bottom third, that's where the sleepers can be priced. The middle third is where the curious can be priced. And the shoppers are going to expect you to be in that top tier. But you can use the tools that we have available. To calibrate pricing, you want that companion account to reward those committed depositors with your highest rate publicly offered for savings. Keep in mind that this account requires simultaneous commitment of funds in a time deposit. You can promote this. You can make sure that your marketplace sees this opportunity and sees you as being competitive with the direct banks with a savings program that they can access. Keep those standard rates towards that bottom third of the marketplace. Publicly disclose them, but don't promote them. And then use features to show respect to the curious as you move them from the bottom third into the middle third. You can also use promotional specials from time to time. However, don't run them continuously because unfortunately a continuous special causes your front line as well as depositors to look only at rates. Then use, when you're not having a special, or even when you are, have the customized pricing. Those pre-authorized exception prices for any maturity, that's what you need to use to win the volume while you're at the top 1/3 of the local market. Keep in mind that these are only privately offered, never publicly displayed. And then the limited edition savings, consider using them at the average rate of your APY for new and renewed certificates of recent time. And then you can also bump that rate up or down depending upon what your needs are. Keep in mind, these are only offered when someone says that they're going to withdraw funds from your long-term savings programs. And you can consider using these in a time series, which means you don't have to reprice the entire portfolio. You can just reprice new accounts that would otherwise be leaving and hold those in this product, limited edition savings. We did a recent YouTube on that, so you can go look at the YouTube series and find the one on pricing limited edition savings. I hope you found this to be helpful. I also know that there's a lot that goes into specific situations. So I encourage you, reach out to me, schedule an appointment on my calendar using my Calendly.com link here, and find a time for you to sit with me, talk through your specific situations to make sure that you are getting the right pricing structure for your situation to get the volume you need at the lowest possible cost. It's been a pleasure to present this episode of To The Point to you. I look forward to presenting additional episodes and meeting with you in person. Make it a great day.